Welcome back to Rockstock Channel. I'm Howard's AI avatar, and I'm here to give a quick intro for today's episode. The real Howard is currently on vacation in Costa Rica. It's January 18th, and today we're resharing an X Spaces we hosted on Tuesday focused on lithium and the critical minerals complex as we head into 2026. In this conversation, we connect the threads that have been building this month: lithium inventories and restocking dynamics, energy storage demand versus EV demand, supply discipline and project economics, and what actually matters for battery materials investors across the next cycle. We also get into the role of policy and geopolitics in critical minerals, including how supply chains are shifting, where the pinch points are forming, and why a handful of less talked about materials are starting to matter more, from rare earths to specialty and defense-linked inputs. Joining me in this discussion are my partners, Rodney Hooper and Matt Fernley. We're also joined by Andy Leyland of SC Insights and Chris Barry of House Mountain Partners. And we have fund manager perspectives from Tom Woolrich of Deutsche Rohstoff and Tomasz Nadrowski of Amvest Capital's Terradon Critical Materials Fund. After my intro, we'll roll directly into the Full Spaces recording. But before we go further, a quick housekeeping note that this content is for informational purposes only and should not be considered investment advice. Please do your own research and read the disclaimer at the end of the video. And I'd like to thank our sponsor, USCF Investments, which is a pioneer in commodity ETFs for nearly 20 years. Their 15 funds include single commodity exposure, broad diversification with SDCI, and themes like ZSB for battery metals and USG for gold with income. To find out more, watch our inaugural episode with their CEO, John Love, and visit uscfinvestments.com. And with that, enjoy the discussion. Good morning, everyone, and welcome to RK Equity's first X Spaces for 2026. We're planning to do this a few times a year as a more informal, interactive extension of the work many of you already follow us on across Rockstock Channel, the Recharge podcast, and our written research. The timing of today's discussion is very intentional. Over the past week, we've put out a lot of interconnected content, and today is about pulling some of those threads together. Last week, many of you may have already heard on Rockstock Channel, we published a Rockstock recap with Arcane's YJ Lee, where we spent a good amount of time revisiting lithium inventories, demand surprises, especially from energy storage, and how different this cycle may look versus the classic EV-led cycles of the past. And earlier today, Matt, my partner Matt, and his co-presenter Cormac O'Lair published the first episode of the Recharge podcast, which digs deeper into some of those same themes: energy storage, discipline on the supply side, and what actually matters for battery materials investors heading into this year. Matt also published his 2026 battery materials outlook yesterday, which I'd strongly encourage everyone to read. That's available at blog.rkequity.com. A big takeaway there is that while EV growth is slowing in certain regions, energy storage is becoming the marginal driver, and that has real implications for lithium, nickel, cobalt, high purity manganese, and beyond. And last week, I published an update to the strategic lithium reserve concept I published late last year, a white paper, which is really about reframing lithium not as, a hype cycle commodity, but as critical infrastructure, something where volatility itself is a policy problem, not just a market feature. And lastly, I want to make reference to two things that landed in my inbox yesterday. One was Deutsche Bank upgrading the lithium sector, following many other investment banks, but they moved to a buy on Albemarle, SQM, and Lithium Argentina, explicitly citing tightening inventories, stronger than expected energy storage demand, and a faster path toward market balance. Their revised pricing deck lifts their 2026 lithium carbonate assumptions materially and pulls forward the point at which the market tightens. We also saw Goldman Sachs trading desk in London, not their research desk, but I get emails from them flagging many of the same dynamics: inventory drawdowns, the impact of Chinese policy, the growing importance of ESS relative to EVs. The common thread across all the sell side right now is that lithium is no longer being framed as too early or uninvestable, but it's moving back toward fundamentals. So today, I want to have a conversation connecting these dots: market policy, capital discipline, and what actually matters looking into 2026. I'm joined by my partners, Rodney Hooper and Matt Fernley, who I'll bring in shortly. But we're also fortunate to have a great group of confirmed participants who will jump into this discussion and Q&A. There are three sell-side kind of service provider analysts: Andy Leyland of SE Insights, Daniel Jimenez of ILI Markets, Chris Berry of House Mountain Partners, and we also have three fund managers: Tom Mulrich of Deutsche Rostoff, Thomas Nadrowski of Amvest Capital's Terradon Fund, and YJ Lee of Arcane Capital. But before we go further, just quick housekeeping note and disclaimer: we will be discussing stocks today. Some of the companies mentioned we may own personally or are RK Equity clients, and we may act as strategic advisors to. But we are not, of course, financial advisors. Nothing in this discussion should be considered investment advice. Please do your own research. This Spaces is being recorded and will be republished as a Rockstock channel video, sometimes next week. And just a few more words. RK Equity, obviously, we've been doing lithium for quite some time, but over the past year, we've diversified well beyond lithium while staying anchored in lots of critical minerals. So we introduced cesium last year with a big success with Power Metals. We've been long connected to titanium and rare earths through Hyperion X, also seafloor minerals via the Metals Company. And two news stories we'd like to flag are in high purity alumina. We just published a second interview with Richard Seville of Advanced Energy Minerals, and also First Phosphate. Both of these are Canadian projects. First Phosphate's listed on the TSX, ticker symbol PHOS. Advanced Energy Minerals is on the ASX. So have a look at both of those. And finally, some final plugs. If you like this discussion, please follow us on X, at Matt_Fernley, at Rodney Hooper 13. I'm at Lithium Ion Bull, and RK's Equities handle is at RK Equity Rocks. And please also go to YouTube or Spotify and subscribe to Rockstock channel there. And finally, we have several new initiatives planned in 2026, including the relaunch of a paid service via Patreon for retail investors. We'll have more to say on that soon, but in the meantime, feel free to DM me on X or email us at rockstockchannel@rkequity.com. And with that, let me hand it over to Rodney first to kick us off with some macro context, and then Matt will summarize some of his takeaways from his first recharge and 2026 outlook. Over to you, Rodney. You're on mute, Rodney.
Okay, great. Thanks, Howard. One of the themes that I've been looking closely at for a couple of years now is effectively the debasement trade. We see a lot of the Western economies running very high debt to GDP and running very high current account deficits and budget deficits, some of them 6-8%. When we're in peacetime and not in recession. So this seems to be pointing towards a lot of sovereigns, institutions, and retail looking to swap out of paper promises into hard assets, and in particular into certain commodities. Gold has obviously had a good run, but then you look at something like silver, which meets at the intersection of an industrial metal and a semi-precious metal, and that I think is up about 170% on the year. So I'd be interested to hear from a couple of the speakers, including Tom and obviously YJ, if he's on, as to what their thoughts are, because it looks like structurally those three investor groups are shifting and are looking to hold a higher percentage of either their assets under management or sovereign wealth in non-financial instruments and rather in commodities. So we'll have to look forward. YJ, I'd also, or others who have looked at it, I'd be interested to hear your views on the substitution of copper for silver in solar panels, which is one of the main growth drivers for silver, and when and at what price that becomes an issue. But certainly there seem to be interesting alternative investments into what has been a dormant sector in the precious metals, but it's running now. So back to you, and Matt, your update.
Thanks, Rodney. Yeah, it's certainly, may we live in interesting times, and it's certainly been interesting times over the last 6 to 9 months, and certainly more interesting and exciting times than it was over the preceding 1 to 2 years. So it's great to see lithium running and other commodities running as well, though not as much as lithium. I think that the thing that sort of occupies me a little bit now is that I think if we would have turned around and spoken to most of the people in the industry 12 months ago about lithium prices being up at sort of $25 a kilogram, they would have said, well, you know, that's probably the peak of what we expect in the next cycle. But we're there now, 6 months after the trough, in terms of Chinese spot prices. So really, where do we go from here? How strong is demand, and how strong is demand growth going to continue to be? I think Rodney's point about potential substitution for silver into copper in solar panels is also potentially important in the lithium-ion battery space, particularly with regards to ESS applications and potential substitution around lithium-ion into sodium-ion. So those are the sort of questions I'm sort of really interested in going in. And then the final question is how elastic supply is going to be to higher prices. How quickly can we bring new supply into the market, and what sort of supply is that? Speaking to a client the other day, and they made a very important point that, you know, are the projects that could come on in the next 12 to 18 months really the right projects to bring on to run through the cycle? And I think that's a very interesting point as well. So interested in people's perspectives on that. Outside lithium, we've looked in a lot of commodities over the last sort of 6 months, rare earths. We've looked at antimony and minor metals. We looked at silver as well. Really interested in people's views on some of those other metals as well.
Great, thanks, Matt. I want to actually invite Andy Leyland to speak first. He runs SC Insights, and you know, a number of firms have been publishing in the public domain, you know, some of their recent you know, thoughts, and Andy does a great job, you know, every few months or so, but I haven't seen anything yet in the new year. But you emailed me, you have 5 things to watch for lithium in 2026. So Andy, why don't you kind of run through those here?
Yeah, thanks, Rodney, and thanks, team, for having me on. So yeah, I mean, I think
I'm
the
Howard,
first thing
by the way. I'm Howard. It's all right.
Sorry. You're coming up as rock stop on this, Howard. Sorry, but the first thing we sort of sent out to our clients, you know, early this year was, look, we're going to see a huge number of forecasts being revamped higher. We're probably the only sort of, you know, major independent group out there who hasn't had to revise our forecast, because we did see this happening based on our analysis of supply and demand in the market and what's happening on the ground in China. So first thing is, you know, you're seeing basically most of the forecasters, particularly the banks out there, chasing the facts on the ground, becoming a lot more bullish, moving to buy ratings, as you said. That will probably, you know, expect for a little while longer. The issue is, this sort of leads into another one of the points, is that they're all very much relying on the same argument, which is, strength in ESS demand. And while, there is strength in ESS demand, it's not the silver bullet or the panacea that I think many people make it out to be. The other thing to bear in mind, and Matt sort of mentioned this already, is that the stronger that you have ESS demand, the stronger you're going to have the lithium price. And the stronger you have the lithium price, the quicker sodium ion becomes cheaper in energy storage practice than lithium ion does. It's not there at the moment. It's still cheaper in China to buy an LFP based battery and put it into energy storage. That will change at some point with prices, over $20,000 per ton. You get a lot closer to warranting the investment in sodium ion. And once that happens, there's a large chunk of that market which can go to sodium ion. We've seen CATL order up to 500,000 tons a year of sodium ion cathode active material. Clearly, they're looking at this in a large way. So I think, this could be the year of substitution away from lithium in that key ESS market, and that a lot of the forecasts out there don't really look at, don't really understand how tight the lithium market is, but also don't sort of follow through on what the impact will be with sodium ion in the medium and long term. The next point, to sort of 3 of 5, is another trend that you're going to see this year is, obviously we'll see some projects move to FID and follow what happened with Vulcan last year. Those are projects which are all, pretty far down the road. And, you probably see some boosts in prices there as they move to FID. The issue we have, though, is last year we saw an absolute collapse in feasibility studies coming out. So there's a huge number of projects which are just recently economic again and recently investable again with price increases, but their feasibility studies are now 2 to 3 years out of date, and they're probably going to have to redo those, or at least update them. So I think you're going to see a lot more activity in the feasibility studies before people can actually reach final investment decision for these projects. Which brings us to the 4th point, which is, we do a huge amount of cost analysis here at SC Insights when we're supporting both debt and equity finance into the supply chain. And what you're seeing at the moment, I think, is the beginning of another sort of set of CapEx blowouts in the lithium space. And it's really important because, if you have CapEx levels at, $50,000 per ton, and your operating cost is, a nice respectable $7,000 per ton, then your CapEx repayment is basically doubling your operating cost. When we look at some of the recent projects like Vulcan, with even higher CapEx per ton levels, the economics of these projects starts getting pretty shaky, even at levels around $20,000 per ton, which is actually higher than most analysts, including our own long-term incentive price. So something to watch out there on the CapEx side of the market, because we're seeing a lot of creep higher there. Final one is there's going to be quite a big change in the lithium market with what products are bought and sold. I'm sure everyone listening here is quite comfortable with the spodumene market and the battery grade carbonate and hydroxide markets, but what we're seeing this year is a huge number of projects moving forward that are basically looking at intermediate products, partly to lower that CapEx. So we're seeing a lot more focus on chloride, a lot more focus on sulfate, and a lot more focus on dihydrogen phosphate. So they're my 5 sort of key things for the market: change in forecasts, increase in feasibility studies, focus on CapEx blowouts, lithium substitution in ESS markets, and new lithium products.
Appreciate that, Andy. If you can kind of summarize that, there seemed to be some negativity there, or a little bit wet blanket maybe on the substitution of sodium ion in the ESS market. It is something Matt has also flagged as a risk. But I guess what is your we had YJ on Rockstock Recap last week, and he was talking, I don't know, 400,000 or 500,000, ton gap or growth in lithium this year, each of the next 3 years, with supply not at all coming close to being able to meet that. He didn't forecast a specific price, but it definitely seemed, and he's outlier optimistic. But like, where are you on, supply demand balance, given the factors that you just mentioned? And some people, Matt mentioned, a contact we had yesterday, talking that it's a nice blip we're seeing here, but maybe people are a bit over optimistic in the near term and not optimistic enough, kind of medium term. But like, there might be a pullback, from all of the exuberance we've been seeing lately. Like, so where are you thinking, Andy, throughout this year and the next couple of years?
Yeah, so the important thing is not necessarily whether we're in surplus or deficit. It's the available tonnage in the market in terms of days of consumption. And that's because this is a market that's growing at 15-20% a year at different parts of it. So actually surplus deficit doesn't make that much difference. It's the days of consumption, which the more you're demanding, the more you need every day. So actually the market, while in surplus last year, was tightening in terms of days consumption. That's continuing, and we're now moving into a deficit, which is exacerbated at the moment by a restocking cycle. So I wouldn't be surprised if this restocking cycle and these huge increases we've seen on GFEX basically come to an end in the next couple of weeks, as China moves towards the new year, and as you're not going to get any of that material before the new year. That would be the restocking cycle done. You may then see some price weakness, but that restocking cycle has bled into what we have called for a long time a structural deficit position, that it's seeing the amount of inventory available draw down. And we maintain our forecast of a market deficit of around 85,000 tons per year for the next 3 years, which really sucks up a lot of the material. And what's difficult is for any mechanized project in Australia, in Europe, in North America, in South America, I'd include Zimbabwe in this now as well, you are going to take a couple of years to see meaningful supply response. The supply response that can come quicker than that needs these higher prices. So that's more lower grade material from Africa, more Chinese lepidolite, etc. And it's something that we've been saying again for a long time, that the fourth quartile is far more price elastic than the second and third quartiles in this market. So for us, we're going to see this sort of sustained deficit. We're going to see prices go high. Our forecast peak for an annual average is, I think, $42,500 per ton. That's been out in the public domain for 3 or 4 months now. So yeah, still pretty bullish, but you need to follow through on what the consequences of that big price increase are. And it will be, substitution. In the last price increase, you couldn't substitute away from lithium ion for electric vehicles because energy density is so important. With ESS, it's just not the case. We're only using lithium ion because it's the only thing there. It is not a solution that is tailored for that end use.
How fast do you think sodium ion can, catch up or switch? Because, I'm hearing if you see 80 to 85,000 deficits for each of the next 3 years, and you're thinking that prices are going to peak at 42,000, and we're now at just passed through 20. So, another doubling of the lithium price, on average, or is that a peak 42, or is that like on average? So just if you could address how easy is it to switch? Because the argument for sodium ion was that the supply chain still needs to be built out for that. And, it hasn't been a lot of years that they've been developing it in the same way that lithium ion has many more years of history.
I mean, we've all been around long enough to have underestimated how quickly China can build an industry, right? So I wouldn't underestimate that. On the price issue, where I said the 42,500, that's an annual average. So that would imply a peak price much, much higher than that. But that's what you have to forecast if you view the inventory situation getting that critical. And if you are somebody like CATL who just wants to produce batteries, and we speak to them quite a lot, they will use what raw materials they can, and they have started putting their eggs in the sodium-ion basket. So I think you are going to see a response there. What will be interesting to see is you don't necessarily need to build entirely new factories. They need a lot of reworking to move from lithium-ion to sodium-ion. It's not an easy process, but it can be done. You still have massive overcapacity in batteries in China. So the industry there is probably about 65% of its capacity utilization. So there's a lot of capacity that isn't being used because there isn't demand for the batteries. So yeah, I think that change to sodium-ion will happen over the course of the next 12 months, assuming lithium prices stay high, and that a lot of that demand will never come back. But don't get me wrong, it is still a very bullish picture. It's just you need to sort of follow these things through.
Okay, Andy, if you're saying the annual average over the next 3 years is going to be 42,500, twice the current price,
that was a peak. That was a peak, not the. Our forecast is lower in 26 and 28. That's a peak in 27.
Okay, so peak 27 is 42,500. What is it for 2026?
2026, I think we've got about 19 at the moment. So again, what we would expect to see over the coming months is a slowdown in the increase in prices as the restocking cycle comes to an end, because you do have a seasonal restocking cycle in China. It's also worth mentioning that this is a increase in prices and a move to deficit that is purely driven by China. But nothing's really changed in the rest of the world over the past few months. If anything, the situation a little bit worse in EVs, a little bit better in ESS. But in China, you've got a strong EV market and you've got a strong ESS market. Okay, I want to turn to two buy-side guys, Tom Mulrich and Thomas, just to actually just talk lithium a minute, because we had, again, Deutsche just upgraded. We had a whole slew of upgrades earlier, at the end of last year, UBS, JP Morgan, Barrenjoey, Macquarie, I think. And I don't have all of their, forecasts in front of me, but lithium equities started to rally in the third quarter of last year, and they typically run ahead of prices, and the price has increased now. So a question is what lithium price are being priced in to lithium equities today, right? So if Andy's right, and the market's going to look at 2027, not at 2026. So if he's right about 42,000 or so in 2027, there's a lot more upside potential here. But what do you think, Tom and Tom? Just comment as buy side investors who have made money in lithium, is being priced in here. Is it the past rise, or is the rally that we've seen in the first few days of this year, portending a lot more upside to come?
All right, I'll jump
Either
first.
of you.
Thomas here.
Okay.
So yeah,
Thomas again is the Terraden fund run by Amvest in New York. And Thomas, actually, if you want to plug, you have a book coming out, I think, Thursday. For our listeners here, you're less well known than some others. So Why don't you introduce yourself a bit?
Sure, yeah. So Ambus Capital is an investment management and banking platform for natural resources here in New York. And Ambus Terradon, I'm the portfolio manager. It's managed by Ambus Capital Investment Management or Asset Management. And we focus exclusively on critical minerals, which we define as essentially three segments: rare earths, battery materials, and specialty metals, so smaller markets. It's a long-short fund. Just on lithium, for starters, you're right, Howard, we've enjoyed 2.5 quarters of a rebound now after 3 years of pain. It's been extremely pleasant. I'm concerned about the extreme elasticity of the fourth quartile in this commodity, and especially what we've seen from Jiangxi operations in the past, and how easy it is to maintain these operations and to boost them at a loss, because CATL does it as a loss at Jiangxi mine. They can afford doing this because of vertical integration, of course. What's more puzzling is that other operators there also maintain production even through bad times. In our view, we're close to the equity top right now, because that elasticity would mean that there's going to be a plateau at 20,000 somewhere before we get anywhere further on the back of stronger incentive. I agree with the previous speaker. ESS is really a Chinese story. And I think in general, we're here in a Chinese story. There's little hope, I'm afraid, to see a major redevelopment of the EV dream in the West. I spent a little bit of time in December in Europe talking to people who were early adopters. There's a concern, a different type of concern there in countries that were early adopters, like Norway, for example. And not so much about the cars from the perspective of their electric battery, but because they're software enabled. And software enabled cars today, if they're, say, imported from China, they are capable of autonomous driving. It's, of course, there is no regulation allowing for this in Europe, but there are concerns because these vehicles keep sending signals somewhere. Now, you can try and switch off those signals, as in some countries that are operating Chinese EV buses are trying, but then you're losing the maintenance over these things. And unfortunately, the track record of EVs is not great in terms of repair and maintenance. That concerns the Chinese market as well. So you have this continuous reluctance for the second wave of adopters to move into something that goes into a repair shop within 6 months and loses 20% of value the day you purchase that. So it doesn't mean that this sector is lost, but a lot of excitement is lost because just, there are significant mechanical problems. Then you have a story of BYD, which is a cautionary tale because we see here at Tesla not generating earnings, but it's still better than BYD, which completely doesn't generate any profits. I think in the third or fourth quarter, profits were down 33%. So you're building scale, but for no economic reason, really, for a strategic reason. That strategic reason is also closing. Look at Mexico's tariffs. So you're back into the battery business rather than EV exports that will probably not grow anymore any further unless suddenly there's more markets opened in Africa. And the battery business will depend on the regulatory system in China. The Chinese are reluctant to allow the high-end batteries to be produced outside of China. And we saw that there was a fall in terms of the exports of batteries, in favor of cars to the European market, especially because the US market doesn't matter. And so if more countries adopt policies like Mexico, then suddenly the gate is closing. And there's been a slowdown in adoption within the Chinese market as well. It's simply saturated. So yes, of course, ESS is a great story in China for completely different reasons, as we know, strategic independence and domestication of energy sources. But there's also a finite story. So what's the next one beyond? And 2027, what will the story be? I don't know right now in terms of technology, but we're extremely cautious and we're watching this, with some trepidation. Look at Albemarle, what it's done right in the last two or 3 months. It's remarkable, and there's always a speculative bubble at the end of these things. So I'll be very, very cautious watching this cycle now.
Okay, Thomas, we haven't spoken, and so good to hear that. A bit of a cautionary wet blanket close to the equity top. You think the marginal fourth quartile is very elastic, so more supply coming from there, and bearish on EVs, in the West. Okay, Thomas Woolrich, what say you? Are you selling lithium stocks or are you buying lithium stocks? Tom, you there? Okay. I see him there, and but he hasn't raised his hand to speak. So I guess, he's not listed as a speaker yet. Okay, if anyone else wants to, chime in, Jody DeRouge, I see there, Evan Cranston, feel free to raise your hand. Would love to hear your thoughts. Matt, if you have any response to what Andy or Thomas just said, feel free to chime in. Otherwise, I may turn to some other commodities because Thomas covers much more than lithium.
Yeah, I mean, I would say there's some really interesting perspectives there. Thanks to Thomas. I mean, I think on EVs, I am a little bit more bullish on the world ex-China, ex-US, ex-Europe. I think you cited one market there, Mexico, but there's huge growth in EVs elsewhere in Latin America, elsewhere in Asia, and even in Africa. So I think I think we saw something like 45% year-on-year growth in ex-US, China, Europe EV sales in 2025, or it's looking about that level. And I'm certainly expecting strong growth in those regions over the next couple of years as well. So while we are seeing a little bit of a slowdown in the rate of growth of sales in China, and obviously we have some concerns about the US next year, and Europe looks okay. I think that I'm not panicking on EV sales. I think EV sales growth is going to be robust. And then in the ESS space, I actually am in the camp that the ESS demand story will last a lot longer than some people are suggesting. I think a lot of analysts are suggesting it might be like a 1 to 2 year story. I think it's a 10 to 15 year story. I published in my blog middle of last year about how I felt that a lot of expert analysts were structurally underestimating renewables installations over a 10 or 15 year period. And I do also feel that there is the potential for people to structurally underestimate ESS installations over a 10 to 15 year period, because there is this feeling that ESS is just about renewables, but it's not. It's moving out into other parts of the utilities network. It's not just about utilities, it's about commercial and industrial, it's about residential as well. So I think that there's a major sort of multi-year event there. I do tend to veer towards Andy's view that there will be sort of substitution out of that. I have said in a number of blogs, etc., that I am a little bit worried that if lithium prices overshoot, then we may see substitutions into other technologies and other chemistries in ESS. That being said, I think that there will still be relatively strong demand for lithium-ion batteries in ESS. So yeah, that would be my general comeback. Howard?
All right, thanks. Tom, are you now able to speak?
Yeah, does that work?
Yes, excellent.
Okay, good.
To hear you. So Tom Woolrich of Deutsche Rohstoff, we've had him on Rockstock channel going through his models on Q2 metals. I think also you're a shareholder in Wildcat. If I misspoke there, just let me know. But before talking about either of that, if you could just address, do you think we're, at a top, for lithium equities? I know you're cautious here, or is the market have further to go, toward 2027, forecast of, 40,000 as, Andy suggests might happen?
Yeah, I don't spend as much time looking at supply demand models like the rest of the panel. But look, what I've seen more recently and listening to your talk last week with YJ, which was amazing, and what you're seeing in the spot market is certainly extremely bullish. Now, when's the top going to come? Who knows? Ganfeng's up 150% off the lows. That's the one I mainly look at because it has high beta to lithium chemical prices, all of them, which are all themselves correlated. So it feels like we've still got a little bit of a way to go. Lithium, I guess it's 4.0, the fourth major lithium bull cycle is well and truly started. Just a few comments on the previous talkers. Sodium, we kind of saw that before. I see it a bit like lepidolite. It's kind of used as a threat to try and drag down spot prices for lithium. I think I've said this before on your show, or at least to Rodney and Howard. Lithium's the third element. It's sodium's 1.8 times heavier, and all the capex up until now has gone into lithium. So I'm certainly placing all my bets, at least, when it comes to picking equities in the battery space in lithium companies. Is that good? Anything else? Did I miss anything?
No, I guess if you're not so much looking at the supply and demand, you can't so much respond to.
That's right. I'm just reacting to spot and what I'm seeing in the equities, and it's really pumping. We're nowhere near, at least in terms of, in quotes, overvaluation in the equities to what we were a few years ago. So I'm not that concerned staying long. And yes, we do own Wildcat, and added a bunch of other stuff recently as well.
Okay. I guess it is January, and often there's a January effect of funds flows coming into the various sectors which performed well last year. So the backdrop for commodities has been very good: gold, silver, copper, lithium. I wonder, I haven't seen any data to this, but to what extent, financial advisors are telling their clients that, hey, you need to have, more exposure to both precious metals, from a debasement trade, macro scenario, as Rodney was suggesting earlier, but also the critical minerals trade, because it's been such a dominant feature, under Trump. Thomas, your fund is based, on that. Maybe you have some idea. I don't know what kind of inflows or not you're seeing. I'm sure your performance was spectacular last year, but if you can comment, broadly on funds flows and critical minerals sentiment generally as an asset class.
I wish I had something positive to say about it. I think we are still in a very peripheral part of the capital market in general. Things improved a little bit in the summer over the time where the MP Materials deal was set up in Washington. So that shed a spotlight a little bit on this space. But overall, it's still a hard slog. Mainly because people have seen these things before. They saw the lithium thing in 2016, 2017, followed by 2 years in the desert. And then again, after the pandemic for 18 months, followed by 3 years in the desert. And, time horizons for large allocators are a little longer than 2 years. So this is a tough sell. We're trying our best. We try our best by focusing on those spaces that really are sustainable. And of course, rare earths is one of these spaces because it's the most politicized, ironically, of all. But you have to be discerning what you're actually picking there among those 16 or 17 elements. It's not always easy when you look through, equity proxies. But I think we have now a good set of data from last year as there is the beginning of Western prices emerging in Rotterdam, showing how important this premium is of Western prices bifurcating from Eastern prices. In terbium and dysprosium in the West were about 400% up for the year. They were flat in China. So capturing that, and that's precisely what we're trying to do at Vestera, and we're trying to invest exclusively, as you know, Howard, outside of the Chinese value chain. So this is happening, and this is happening predominantly because of the Chinese agency, right? There are decisions. This was their decision last week to announce that there are going to be rare earth curbs on exports to Japan, because Prime Minister Takaichi back in November said, sonritsuki kijitai. So existential threat situation to the country at a parliamentary meeting. And that, of course, led Chinese Communist Party into an apoplexy because it relates to their plans in Western Pacific. And then, of course, we have this particular sector that's been used as a leverage. And I caution investors who try to copy that model onto other commodities. Because what's true to rare earths or spheronized graphite or gallium, where China is a near monopoly, especially for heavy rare earths, it's not true for, say, silver. It's not even true for tin, which is having a fantastic run too. But it's having a fantastic run. At the same time, we have 6,000 tons of inventory accumulating, doubling since November. So it's not the case in all the materials, but we've seen, for example, that most materials respond to those threats more than others. Tungsten was 194% up last year. There's a good reason for this. 82% of tungsten is dominated by Chinese production, and that's for mostly geological reasons, unlike many others. So it's a space you have to be careful because we're not used to this. In mining, what did we do in the last 30 years? We're basically feeding the dragon. And now you have to just think, how is this space being reorganized when you have the bifurcation of the value chains, when you have the spreads between, say, COMEX and LME responding with premia, but these premia often predicated on non-economic decisions. One is a threat of Section 232 here. Another one is, of course, another set of restrictions by China, of which we have counted 23 since 2023 on different products, of which only 4 have been suspended for 12 months on a conditional basis. So this topic's not going away. And I think investors should pay a lot more attention to it, because we're not going to solve this problem within 2026. It's not over yet. So it's a multi-year effort to rebuild these value chains, and we see a lot of opportunities there. But they're not going to apply to silver, where China has 23 LBMA refineries. Back in my time, they had 2, but now it's 23. It's considerable, but there are 83 or 84 around the world, right? So silver is definitely not going to be cornered by just supposedly accumulation of inventory. And anyway, that price never runs on industrial demand, but only on investment. So, discernment is the name of the game here, and finding what's changing about the flows and who controls the choke points. And that's what I explain in my book, by the way, which is out the day after tomorrow, Mineral War, if anybody's interested. But that's it's a new world for all of us in mining, and we just have to adjust accordingly to changing conditions.
Okay, there was a lot in that, Thomas. A lot of minor metals, but at the same time, inflows. What you see, institutional investors that allocate capital to hedge funds, long short hedge funds, are very slow, and the market's been so volatile, so controlled by China. And until last year, there hasn't really been, voice from the bully pulpit, in support of this
agree.
industry.
So exactly what you're saying. People, instead of seeing this as an opportunity that can be clinched by experts, see it as a threat, as a downside, potential liability, because they can't stomach the volatility. And no, even if you run a long short fund, of course you have a liquidity constraint on the short side, and at these interest rates, it's not always really, if you're risk averse, you're gonna have a problem with that short side. So I understand those constraints from the allocators up to a certain point, but if they think strategically about the redevelopment of the industrial base, without which this is just not going to happen, then the floodgates sooner or later have to open. Maybe we need a second year like 2025. Maybe that's what happens. Maybe then FOMO really kicks in. FOMO sapiens.
I think there's a decent chance of that because what we found is retail has clearly been playing the spaces that you're talking about. MP Materials and a whole host of other rare earths niches have seen kind of meme stock behavior, but most institutions won't touch such companies, hedge funds and the like. It's interesting. I mean, every year at the end of the year, Deutsche hosts a lithium conference, and I'm on a panel every year. And Corinne Blanchard most of their clients are hedge funds, right, in lithium. And she was saying at the end of November, early December, that there really wasn't that much interest, from hedge funds. The inbound calls wasn't so significant. And here she is out with a brand new note yesterday saying there's interest, right? So that tells me New York hedge funds are playing lithium, at the moment. And there were a lot of shorts against, Sigma, but Sigma has tripled. Matt called that pretty much, and Lithium Argentina in a June podcast, last year. So, but in lithium and rare earths, at least you have producing companies with profits. The market's gotten some education from the companies about the sectors. A lot of the commodities you mentioned, Thomas, are tiny markets with no information. I think it's likely that the critical minerals for the attic, it's going to be volatile, but the tailwind on the reshoring is very strong. But also, AI and defense and all of these applications, I think it's likely we'll have another good year in the minor metals, as well as, it looks like, and maybe Rodney or Tom, you do a fair bit of gold and silver, a bit, I think, may perhaps contentious on, silver market won't be cornered or industrial demand is not so relevant. And I think Matt was making an argument that industrial demand is actually an important factor on silver. So maybe Rodney, Matt, Tom, why don't you chime in on silver and some of the other comments he made? Whoever wants to jump in first, feel free.
Sorry, Howard. Let me just correct what I said about silver. I didn't say the industrial demand doesn't matter, but in any precious metals, it provides the floor under the market. It's not a driver. The investment demand is the driver. Two different things.
Okay. Rodney, you want to say something? We can't hear you, Rodney, but I see you've unmuted yourself. Matt or Tom, while we're waiting, if you want to unmute yourself.
Yeah, I I don't want to be always disagreeing with Thomas, but I think on silver, for many years it has been a paper-driven market, but I see it increasingly now moving towards a physical-driven market. And if you look at the physical supply-demand balance, the market has been in deficit, I think, for 5, 6, 7 years now. And obviously, I hear what you're saying, that there's a lot of investment. There's a lot of material potentially in inventories that are not in warehouses and whatever that can come into the market at some point or another. But I think prices are up very, very substantially over the last 12 to 18 months or so. We've got more material that's come out of where it's been hiding, but we've still got a physical deficit. And while we have such a physical deficit, I think that that there's a potential for further positive momentum for silver. I think the only thing that really worries me is the point that Rodney made earlier, and when we've spoken recently as well, that at some point, I think, Rodney, maybe you come back in, that the pinch point for silver and solar panels, I think you said it was around about $130 an ounce. And obviously, if we get to that sort of level, then will we see, silver as a major demand product in renewables? Will that start to sort of drop away? And that's obviously been a major driver of the differentiation that we've seen in the silver market over the last few years. But having said that, I think we've still got quite a long way to go before we get to $130 an ounce. So not panicking just yet. Rodney,
Great, thanks, Matt. Rodney, are you there? All right. How about Tom Woolrich?
Yeah.
Any thoughts on silver?
I don't spend too much time on it. So I get a lot of free silver with my copper and gold miners, right? And that's kind of the reason why I don't invest a lot of time in silver, is it's a byproduct. So for me, when I'm looking to pick stocks, I don't want to be like the rare earths. I don't want to be part of an opaque, difficult market that could move 50. The equities could move 50% based on a tweet from Trump or some sort of news out of China, right? So I just find the volatility is too high in silver. I get it for free anyway. Do I think it's going to go up? Yes. We're in a bull market. It's trading within a channel. You buy red days and sell green days, and you're going to make money on silver. So, it's not something I'm going to spend my 10,000 hours on.
Okay. I think Lithium Price Spot waved a hand to speak. If you want to speak, I invited you to speak, so feel free. And Chris Berry, I just invited you to speak. I noticed you came in a bit later. So once I see you accept that, then you feel free to just chime in, turn off your or turn on your mic. I don't see them, there as speakers, and Rodney is still. I'm sorry, we've had so much, technical difficulty. This is the first time we've done this under the RK Equity Rocks handle. I've done this under the Howard Klein.
Maybe I could just sort of jump in and
it's all my fault. Yeah.
maybe open the floor to a couple of other metals. So obviously we talked about lithium, we talked about silver, we talked about some of the other sort of commodities. Thomas mentioned rare earths. What are people's views on, you know, some of the more minor metals like sort of antimony and tungsten? Copper, do people have views on copper? You know, titanium raw materials, titanium as a whole. Do people on the panel or outside have areas that they'd like us to cover in those areas? Feel free to jump in.
Thomas, I think a number of those are maybe you have an opinion on. I'm not sure that everyone else.
Yeah, I don't want to monopolize. We were positive both on tungsten and antimony, for reasons that there's still a lot of work for Western companies to bring their projects online. We of course are interested in those that were coming first through the finishing line, because our view is that some of these markets post-Western rebuilding will have a structure of kind of oligopolistic monopoly. So it's not like every single company that's drilling now for antimony or tungsten will make it on time. But that's a good thing, because it means that the successful first movers will be able to consolidate those spaces, and we'll have something of an industry maybe 3, 4, or 5 years from now. It's easier for antimony because, of course, often it comes from, you know, gold-related shear zones, and then it's more easily bankable, which is a problem for many critical minerals, more exotic ones. So that of course helps. It's a bit exotic because if you're interested in antimony and an Australian company, but they have to report in gold equivalent only because of the regulation and not an antimony equivalent, then you have to redo the math yourself. It's never perfect. So yeah, these metals matter, and contrary to my comment before, they also matter because occasionally there could be a tweet, or rather a statement from Beijing's MOFCOM that something gets embargoed again, as both metals have been a couple of times restricted and even embargoed, but that was US specific measure from China. And that only accelerates interest, provided, of course, there, you know, can find a way to back these projects. Others, what else? Fluorspar of interest. One interesting project in Utah in construction. Beryllium's over in interest always, but you know, nothing much is going on there. Gallium definitely, but you cannot play gallium easily. It's just basically an aluminum refinery story. But gallium, because of gallium arsenide for optoelectronics and gallium nitride for power electronics, absolutely critical. The second one, because of the high band gap that goes into the military. So it's directly now the DoD investing in these things, but nothing for us in equity to glean from that. Which, you know, basically.
Thomas, can you speak?
Yep.
Can you speak about some of the you know, the best performing stocks in your portfolio?
You see, I'm extremely reluctant to speak in public about tickers.
Okay. Understood.
You know, I can.
You're on the buy side.
Yeah, exactly.
You have problems with that. I get it. Okay. Nevertheless, I tried. Thomas, are you so constrained? Thomas Woolrich?
No, I mean, what do you want to talk about? The lithium, copper, gold equities have all performed extremely well, right? And this goes back to my comment about if you're a retailer or you're listening to the Rockstock channel, you can't understand the vanadium market, right? So, I mean, what can you do if you just stick to the opaque stuff and you stick to the stuff that's working? Yeah, I find those commodities are the best. So copper, you know, we had a lot of news recently, large curtailments of supply coming into demand, and you know, we're looking at We're copper being in a deficit, right? So all the equities have reacted, and that's been a good space. And I think it will continue to do so.
But do you have
Okay,
do you have a view on vanadium market? I'm interested in that.
No, like why, right? So I could do the 10,000 hours and build a view, find a handful of equities to invest in. I might also be stuck in those equities. I call them lobster pots for 10 years. Why do it, right? There is a specific a stock that we did that with called Monty, and the trade did work extremely well. But yeah, my job is now to look for the next thing, right? And my focus is on liquid, large markets.
Gotcha.
Okay, Tom, you're a geologist, as is Matt, and you have spent a lot of time, picking significant winners like Azure, like Wildcat, like Q2 Metals, at least in lithium. Any updates? We plan to have Q2 back on the program very soon, but that has been, within lithium, the hottest kind of still early stage Lassonde curve, pre-resource. Any further thoughts since, you modeled things on our channel, on Q2, or any other new names in lithium or outside of lithium that are on your radar that listeners, may want to, follow you into?
Yeah, I guess I still think Q2 is the pick, right? So it's 300 million market cap US, 400 Canadian. We're looking at maybe 400 million tons. You've got the large cap equities worth 10 billion, Pilbara's 10.3 billion US, Minres is 7 billion, IGO's 4.5 billion. These guys are going to need to expand. The buyer of that asset probably comes from that list, maybe chuck in Rio as a potential buyer of that asset. Well, so you get a tier one globally significant lithium asset for in US dollars 300 million today. I see that as a great buy. So the other point I'll make about what I'm doing differently this cycle is I'm trying to be extremely concentrated, right? So in the past, you could have made a lot of money on assets that had an inventory of 50 million tons of greater than 1% lithium. Those equities attracted billion-dollar evaluations, and they all essentially fell back to zero. So what I want to do this time is really just stick to the top. Elevra's super cheap as well at $1 billion US at the moment. And then we spoke about Wildcat, 380 US. It could be the next producer in Australia. It's on a mining license. It's close to port. These are great ways to get leverage to a lithium bull.
Elevra is new, I think, in that discourse. Why do you think it's super cheap?
Elevra has a handful of assets, and they've been quietly plugging away and then adding lots of tons. I was really surprised to see their resource upgrades in their Canadian assets. Really impressed. Those are going to be mines. Now, Matt, we might be able to get Matt to comment, but Canada's a special case in that they've got all the spodumene and no conversion capacity. But really the next Pilbara is looking like Quebec and Ontario. So something has to happen there. It might be Rio that gets it going. But yeah, the current bull, or the bull that's starting, is going to have to be the time where these large assets get stuck into a complete business model.
Well, I was pleased to hear in Rio Strategy Day that they are going ahead with their Bécancour plant. And it seems that they will turn on Galaxy and turn off Wabuchi. But, therein, lies some opportunity. I think Bécancour will actually be ahead of Galaxy in terms of startups. So I always wondered, will Alevra's possibly feed Bécancour in the short term, if not, longer term. And I do think Rio in time, will be a buyer of assets in Quebec. They are divesting of certain things, but lithium was one of the four pillars. Who the hell knows? Like, if they merge with Glencore, then new strategies may emerge. But Glencore has actually been fairly active in lithium. They were reportedly the prepay of $350 million to Albemarle, last year. So I think Glencore, if Glencore Rio Tinto were to happen, it would be supportive of lithium. But it's still. We agree with you that Quebec, hopefully this cycle will be like the Western Australia or North America. So we actually, Chris Berry joined late, but he now does show up as a speaker. Why don't you turn off your mic, Chris? Chris is of House Mountain Partners. A few others that I mentioned would be on here. For some reason, we're not able to make it. But thankful that Chris is here. Chris is based in Washington, and I saw him at a CSIS, think tank event late last year. There were two events, and Washington and critical minerals is rife with activity. So as we start the year, Chris, though it wasn't on my dance card, that we'd be invading Venezuela, or that. We'd be criminally charging, the Fed chairman, and there have been some talks about Greenland, but it's more about, kind of naval security than critical minerals. So we haven't seen much on the critical minerals front coming out of the Trump administration yet. But, what's your read of the landscape, politically, geopolitically? Because that's been an area that you care about, and how does that translate to lithium and maybe some other, rare earths commodities?
Sure, and thanks for the opportunity, and sorry for being late. Daddy duty calls as the House Uber driver. Anyways, thanks again, Howard. I think in terms of 2026 and maybe even beyond, I think you can expect to see a continuation of what we saw in 2025, just in terms of the Department of War, Department of Interior, or just the Trump administration writ large, writing sizable checks to really focus on building out domestic supply chains. I would say, the Greenland thing, I really don't think that's about access to the metals and minerals. I mean, we all know that there are plenty of rare earths up there, plenty of zinc, copper, you name it. But of course, there's a lack of infrastructure. You can only mine for 3 months a year. So there are a lot of reasons not to really push that forward. My sense is that the only thing I would say about Greenland now that I probably wouldn't have said a week or two ago before the Venezuela raid is I do think you need to take Trump's views or threats seriously with respect to Greenland. I don't know what the future looks like. Is it an annexation? Is it bluster to cut some sort of a deal where we're effectively leasing Greenland from the Danes? I don't know, but just from a pure critical minerals perspective, you're right, Howard. It's not about the minerals. It's more about just, I think, trying to box out the Russians and the Chinese in the Arctic. And so, remains to be seen what happens there. But, more broadly, again, as I mentioned earlier, I do think that you're going to see continued large-scale investment in the more obscure metals and minerals coming from the Trump administration. We actually just last night saw a $450 million deal from the Department of War and the private sector. It was $150 million in preferred equity to Atalco, which is the only aluminum refinery existing in the United States. That was my understanding, was that was really more to go after the gallium. I think Tom, you mentioned earlier, or maybe it was Lynn, how gallium's important, but it's sort of a byproduct from existing operations, and that's definitely the game here, as well as I think ultimately ramping up high purity aluminum. I would say, from an institutional perspective, what I'm hearing and seeing is that I feel like we're back in 2016 or 2015, and we wouldn't necessarily be doing spaces, but you'd go to these conferences and there was this sort of institutional investor curiosity, right? Or there was an informational deficit about lithium and about cobalt, and about the traditional battery metals. I would argue that that summit has been scaled, so to speak, with respect to lithium. I don't think there's an informational deficit there anymore, and I agree with what I've heard a lot on the call thus far about the direction of travel. But I do think there's an institutional thirst for interest and an informational deficit with tungsten, with high purity aluminum, with titanium, with magnesium, with cesium, and so these are the metals that, to be honest, I have spent, and obviously you can sort of lump rare earths in there, but I have spent a lot more time really trying to understand those markets. Yes, they're small. Yes, they're opaque. Yes, they are deserving of capital, but they today, I would argue, are sort of where lithium was 10 years ago. And so that's why I'm spending a lot more of my time thinking about what are the applications here, where are the assets. I think again, I just jumped on the call, but one of the speakers was sort of saying it's really hard to talk about what you own, and partially I think the reason for that is because a lot of these assets or a lot of these companies aren't publicly held, they're not publicly traded, and so that's a challenge with, for example, a magnesium asset or something like that. So you're dealing with byproducts, you're dealing with sort of a lack of information, but I do think that these are the critical metals. I'll use air quotes when I say that are of interest to the Trump administration, and I think are going to be getting much more funding in 2026 and beyond. I don't think you're necessarily going to see much production, obviously, in the next couple of years, simply because we all know how long it takes time to raise and deploy and allocate capital and get qualified by your customers. But it's starting, and so I'm still sort of as bullish as I have always been. I think, again, lithium and copper are kind of the no-brainers of this cycle, but very interested to see what happens with some of these other lesser-known plays.
Thank you, Chris. Very interesting. I just want to add a couple of things, just like thinking there's a global audience we have here, and Thomas, even though he's based in New York, gave pretty much kind of a global view, China, Europe, on lithium, and the US. Like I see a potential demand shock or additional driver, from US interest for lithium, right? I see lithium's not been in favor because it's been tied to EVs, and the Trump is anti-EV and also anti-solar and wind. So from a renewables perspective, but that was last year, right? They passed the one big beautiful bill, and they preserved subsidies and tax credits for batteries in there. So I see a repositioning. I think batteries, and you were talking Department of War, Department of Interior, a lot of gallium, the military is driving a lot of this, and the military needs batteries. So you're going to see that translate into, positive interest for lithium. And then winning the AI race is critically important. So energy storage, affordability and the cost of electricity is a major issue. And backup battery, even if it's natural gas fired plants, as Elon Musk's XAI is in Tennessee, megapacks. A reason that Tesla Energy is doing so well is because XAI is buying megapacks. for their natural gas, powered plant. So I think ESS in the U.S. is an underappreciated driver, and Tesla, we have an American company with a big, lead there, and there are other companies like LG, Redwood Materials, that are playing in this space. So I'm optimistic on those two, demand function, considerations, and also geopolitically, I think China and U.S. dynamic. I mean, Trump and Xi are going to meet 4 times this year, and I think there's scope for some sort of a grand bargain. I take your point, Thomas, that if Europeans are scared about the software, and their data going to China, Americans may be worried about that as well. So maybe a BYD joint venture might not happen. But from a hardware perspective and a chemical perspective or a cathode perspective, I don't see too much risk if Ganfeng, for example, were welcome to build, hard rock conversion plants, in the U.S., fed by, Canadian hard rock, for example. I don't see much geopolitical risk in that. And likewise in cathode and maybe even in battery. But, that's to be seen. I am not a huge follower, have not historically been a huge follower of Venezuela, but, some of the geopolitical, talk that I saw there is that it has potential impact, a significant impact in Iran, and China and Russia, and throws a wrench into a lot of geopolitical calculus there. So what that means overall, I'm not sure. Saudi Arabia, by the way, this week, I think is the Future Investment Forum. Ken Hoffman, who came on and called the bottom as well of lithium in July, I invited to participate here, but he is there along with many others. But Saudi Arabia, and you Chris, have looked at this, has become an important feature. Trump signed agreements with Australia, with Japan, Korea, but also Saudi Arabia. And MP Materials has a deal in Saudi Arabia. So, be interested your thoughts on that was a meandering, slew of information. But if you could respond to any of that, Chris, would welcome your opinion.
Yeah, that the battery side of things. I mean, you sort of started talking about the domestic with the ESS. I totally agree. I think, especially from the standpoint of the U.S. military, I mean, the DoD or DOW, I guess, has they have announced a ban on the procurement of lithium-ion batteries.
Chris, somehow you got muted. Unmute yourself.
Sorry, I'm not sure what happened.
It was something on our end. I just got a message that everybody was muted.
Okay. All right. I'm back. So I don't know where you lost me, but I was talking about battery use on the part of the U.S. military, and that is a big no-no, as you can imagine. The Department of War has actually announced that they're a full-fledged ban on the procurement and use of lithium-ion batteries for defense purposes here in the United States if that battery originates from China or any foreign entity of concern, right? So Russia, North Korea, China specifically, and Iran. That the defense establishment here in the United States will not be able to use that material or use that battery after October of 2027. So we've got about a year and a half, maybe a little bit more, to build a supply chain. Well, I'm not even talking about something here in the United States, but that is built amongst our allies that can somehow feed this insane data center demand, can feed the U.S. military, can feed the electric vehicle sort of push, or just say mobility push. And so I don't know, something's going to have to give there. I'm not sure if we can, if these demand sort of scenarios around ESS, so on and so forth, maintain their pace. I don't see how you couldn't use Chinese batteries. In other words, where would the actual excess capacity come from to feed that demand? And so, again, what's the takeaway there? Well, obviously, batteries are going to stay right in the bullseye, and battery materials are going to stay right in the bullseye with respect to the Trump administration from a funding perspective. But I'm just not sure we can get the funding, as I mentioned earlier, raised and allocated and built in time to compensate for some of these bans. So I'm very interested to see what happens there and how the Trump administration kind of stick handles some of these bans that they've talked about, because they seem pretty severe. It's the right thing to do, by the way. I'm not saying we should just throw up the white flag and import more and more LFP from China. But that's how I'm thinking about that. And then on the Saudi side, you're absolutely right. You took the words right out of my mouth. I mean, there are private sector investments, obviously MP being the biggest one. I think it's just a diversification strategy on the part of the Saudis. Look, oil and gas is what makes the cash register ring over there, and it always will, but it doesn't mean that you couldn't sort of fund some sort of a critical minerals hub, given a lot of, again, whether or not it's data centers, electric vehicles, or just a whole electrification thematic. I think it makes a lot of sense to be there as well. So again, sort of totally agreeing with what you're saying, Howard. I really don't have too much else there, but that's how I would sort of think about that. I think, the Middle East is arguably going to be one of the real beneficiaries of folks looking to locate plants and so on and so forth. Actually, ex-China.
All right, great. Thanks. We're going to wrap up in not too much longer from now, but I see the koala joined late. If would love to have you chime in if you missed a lot of the conversation, but if you have anything you want to share, please do so. While waiting on that, Matt, you're listed there as a listener. Maybe you made some comments about Morocco in your Recharge podcast. Maybe you have some view on Saudi, and lastly, the recent news on China, changing the rebates policy seems to be having some impact on lithium price. I guess if you could comment on those three things, Matt. Still shows you as a listener, Matt, so not sure why that happened, but okay. He had some problems. Rodney also had some problems. I don't know. Elon is not listening, but we've had better experiences on spaces in the past than the technical issues we've had here. But I think why don't we wrap it up? We've been going for nearly an hour and a half, and I appreciate all of you who chimed in. And we will be repurposing this as a Rockstock channel audio podcast in the coming days for those who weren't able to participate the whole time. So thanks all for your support, and look forward to an exciting year. I'm generally kind of more bullish. I think I'm quite bullish. I'm a big follower of the All In podcast. I'd encourage people to listen to their latest interview with Howard Lutnick. If 5 or 6% GDP is going to happen in the U.S., and a lot of good policies ahead of the midterms, you're going to see some surprises, from this side, and equity-wise, and broader equity market and commodity market. I think it's going to be a good year. So with that, thanks again for everybody, and we're going to sign off.